Hello students, this lecture is on accounting for shareholders equity. In this lecture, I'm going to introduce you the comprehensive income. Next, you will learn what is retaining and also the other reserve. And lastly, you will learn how to prepare the statement of shareholders equity. What is comprehensive income? Comprehensive income shows all changes in equity during a period, except those resulting from investments by owners and distributions to owners. Okay, the investment by owners here means um example like the share insurance, because the owner, the shareholders, they invest by buying the shares, and then the distribution to owners here is referring to dividends. So the corporative income includes um, all revenues and also gains, expenses and losses reported in the net income, and also the corporative income includes all gains and losses that bypass net income but affect equity. Okay, the revenue, gain, expenses, and losses in net income, as you know, they are the sales revenue, or if you have any other operating income, and then you minus all the expenses, operating expenses, and you get the net income. And then the gain and losses that bypass the net income, which is the gains and losses that you cannot include it to calculate the net income. Okay, and these gain and losses can affect the equity. So gain and losses, which is not part of the net income but can affect the equity, such as the revaluation surplus. Okay, or if you have any gain or losses from the foreign currency translation. So this is how you present the comprehensive income. So you are all familiar with the income statement. Okay, so in the income statement here we have the sales, and then minus cost of goods, so you get the gross profit, and then you minus all the operating expenses and add other revenue and minus other expenses, and then you minus the income tax expenses, and finally you get the net income. So when you get the net income, so this is the income statement part. Okay, so to get the comprehensive income, okay, to get the comprehensive income, the net income, you have to add other comprehensive income. Okay, what are other comprehensive income? Other comprehensive income such as unrealized gains and losses on non-trading equity securities. Non-trading equity securities is such as if you make investment in other company, okay, you buy shares of other companies. So that is non-trading equity securities. Okay, and then translation gains and losses on foreign currency. Let's say if you buy or sell um if you buy inventories, let's say if you buy inventories from other countries, let's say you buy from Indonesia, so and then you use different currency, like Indonesia they use rupiah, so there will be gain or losses from the translation of the foreign currency. Okay, so the gain and losses from the foreign currency translation will be part of the other comprehensive income, or OCI. And also plus others such as revaluation surplus. So remember, revaluation surplus you have to report under OCI, other comprehensive income. And then when the net income plus OCI or this OCI, you get the comprehensive income. Okay, and this comprehensive income you have to accumulate, okay, with the accumulated comprehensive income, and then you report under equity section in the statement of financial position. So when you have the comprehensive income, this statement will be called as comprehensive income statement. So now we look at how the comprehensive income statement looks like. Okay, so you report the net income figure here, and then you add all the OCIs. Okay, here they have net unrealized gains on derivative. Okay, so derivative also is part of non-trading. Okay, non-trading securities. And then you have net unrealized gains or losses on investment, and then the translation. Okay, translation adjustment and other, which is if you have loss you minus, if you have a gain you add. Okay, and you minus or add the OCI, and then you get the comprehensive income. Here you report the comprehensive income here. Next, okay, so the presentation of a comprehensive income statement, you have to present it or report the comprehensive income periodically. So which means every accounting period you have to report the comprehensive income. So there are two options to report comprehensive income that is created during the accounting period. So the first one is an expanded version of income statement, and then the second option is a separate statement, which is immediately following the income statement. and and then the comprehensive income that you get, you have to accumulate the amount to the accumulated comprehensive income. So the accumulated comprehensive income, you have to report it under equity section in the statement of financial position. So it is very similar to the retained earning. For example, for the net income, when you have the net income every period, you accumulate in the retained earning. But for the comprehensive income, you accumulate in the accumulated comprehensive income. Okay, so it has the same concept. Okay, just bear in mind, for net income you accumulate in the retained earnings, and for the comprehensive income you accumulate in the accumulated comprehensive income. So the retained earning and accumulated comprehensive income you report under equity section. Companies must display the components of other comprehensive income in one of these two ways. So like in the previous slide, so it's either using the expanded version, or we call it one statement approach. Okay, it will be single continuous statement. Okay, just one statement approach, so you have the expanded version of the income statement, or you can prepare the comprehensive income statement, which is separate statement version, which is one, you have income statement, and then another one is comprehensive income statement. So you have the two statement. Alright, so for one statement approach, okay, or the expanded version, so this is how it looks like. So here you have net income. So revenue minus cost of goods sold, and then minus the operating expenses, you get the net income, and then you expand by list down all the OCI, and then you get the comprehensive income amount here. Okay, and then the advantage of using this one statement approach is you do not have to create a new financial statement, so only one statement. Okay, and the disadvantage is the net income here is buried in the subtotal of the statement. So you the net income here will be in the middle here, so you cannot see. Yeah, so it will be inside the statement. The net income will be inside the statement, not at the bottom. Okay, I mean in the middle of the statement. Okay, not at the bottom. All right, the second approach, which is a separate statement approach. Separate statement approach, here you will have two statements. One is income statement, so you stop until net income here, and then you prepare another statement, which is comprehensive income statement, so you start with net income amount. So net income amount minus the or add the other comprehensive income, so you get here at the bottom comprehensive income. So here from these two statements, you can see clearly for the income statement how much is the net income, and for the comprehensive income statement you can see clearly how much is the comprehensive income. Alright, so here under both standards under US GAAP. So US GAAP we got is issued by FASB, and under IFRS standards, um, both the requirement of presenting the corporation income are same. Okay, both IFRS and US GAAP, here under the both standards, the companies can choose to report revenue, expense, and components of other comprehensive income in a single statement or in two separate statements. Okay. Um, before this before this standards these two standards body have the same requirement for presenting the comprehensive income. Before that, US GAAP, before 2011, year 2011, US GAAP allowed third presentation option. Okay, before this, before 2011, for US GAAP under FASB, there are three options. Okay, which is the third option is to report the item of the comprehensive income, the other comprehensive income under in the statement of changes in um, shareholders equity. Okay, before this, US GAAP allow the OCI to be reported in the statement of changes in equity. However, after 2011, yeah, it's not allowed anymore. So only these two options are given to the companies. So the rationale behind the decision to not allow the third presentation option is to clearly segregate the changes in equity arising from the transaction with the owners and uh, transaction with non-owners. Shh, Mama work. Kejap, Kak Rina. Kak Rina main kat bawah ya, Mama work. Okay, so for the statement of changes in shareholders equity, we only show the changes in equity arising from the transaction with the owners only. But for the statement of corporation income, we show the transaction with non-owners. Okay, the changes in equity that arising from the transaction with non-owners. So that is the reason why. So you can see clearly. So both OCI and changes in shareholders equity can change the equity of the shareholders, but the difference is statement of changes in equity is for honest transaction, and statement of comprehensive income is for the non-honest transaction. Alright, next, the nature of the shareholders' equity. So before this, you have learned about all the comprehensive income. Now we look at uh, what is the shareholders' equity. Okay, um, so the shareholders' equity accounts represent the ownership interest of the shareholders in a corporation. So from the statement of financial position, you can get the total of the shareholders' equity here. Equal to the total assets minus total liabilities. So total asset minus total liabilities is equal to net asset. Okay, so in other words, shareholders equity is equal to the net assets. Alright, so in another way to think about that the shareholders equity is that it represents the portion of the corporation asset that have been financed by the owners as opposed to that portion that has been financed by the creditors. Okay, so the sources of the shareholders equity is one is by the owners, and uh, the sources of the shareholders equity is from the owners and also from um, the amount of that invested by the shareholders or the owners here, meaning that when the investor buy the shares, so that is the amount invested by the shareholders and the amount earned by the corporation, which is through retained earning. Okay, these are the two sources, the two primary sources of equity of a corporation. So the issued capital represent the amount of the shareholders have invested by buying the shares for the company. Retained earning here, retained earning reports the cumulative amount of the net income that the corporation has earned since its organization minus the cumulative amount of the dividends declared since organization. So the retained earnings here, okay, all the net income you accumulate all the net income minus the dividend, then you get the retained earning. And the reserve. Reserve here include all other changes in equity except those resulting from the investment by owners and distribution to owners. So it means that, in other words, reserve or accumulated OCI, accumulated other comprehensive income, is the changes in equity by non-owners. Okay, that resulted from the investment by non-owners. Changes in equity that resulted from the investment by non-owners. Um, Sorry. Changes in equity that resulted from the transaction with the non-owners. Sorry, not investment by non-owners, but the changes in equity that resulted from transaction with non-owners. So that is reserve, or we call it also accumulated other comprehensive income. So here is a typical shareholders equity section of statement of financial position. So if you notice here that it reports both ordinary shares and preference shares at par value. Okay, so here you report at the par value how much, and then you report the additional issued capital for both ordinary and preference shares. And then retained earnings, how much is the retained earnings, and then you will have to report the reserve. So here reserve is consists of the asset revaluation reserve. So remember, when you learn the revaluation surplus, or the revaluation surplus you will accumulate in the asset revaluation reserve. And also treasury shares also you have to report in the under equity sections. Okay, and then you get the total of the shareholders equity. Alright, retained earnings. Retained earnings represents the undistributed earnings of the company since its organization. The most frequent changes to retained earnings are increases due to income and decreases due to distribution to owners. Primarily, the distribution to the owners is dividends. Okay, so what usually increase the retained earnings is the net income, and what decrease the retained earnings is dividend. Retained earnings may also be affected by the correction of an accounting error that occurred in the financial statement of a prior period, which is we call it a prior period adjustment. Some loan agreements that place restriction on the amount of dividends that can be paid based on the balance in retained earnings. Okay, so the restriction on retained earnings are generally disclosed in the notes to the financial statement. So in the retained earnings statement, okay, what can increase the retained earnings is the net income. If there is any change in the accounting principle, and also if there is any prior period adjustment. So all these three can increase the retained earning. And what can decrease the retained earning is if the company report net loss, and if the company distribute dividends to the shareholders, and also if there is any change in the accounting principles, and also prior period adjustment. Okay, so this is how the retained earnings statement looks like. You report the beginning retained earning plus net income minus dividend, and you get the ending retained earnings. So before issuing the report for the year ended December 31st, 2019 here, um, here let's say if you discover arrow, 50,000 arrow net of tax that caused the inventory in 2018 to be overstated. Okay, so the inventory, there's an overstatement of inventory that caused the cost of goods sold to be lower. And when the cost of goods sold is lower, so that will overstate the net income. So net income will be higher in 2018. So when the company discover this, what would be the impact on the statement of retained earnings for 2019? So let's um, see what would be the impact. Okay, so here we have to report the beginning. The beginning retained earnings will be at 1050, which is same, and then the net income 360. Yes, sorry, the prior period adjustment will be the error correction, which is 50,000 of the inventory that is overstated, so you have to minus 50,000. Okay, and then you get the balance, the beginning balance of the retained earning that has been restated, so it will be 1 million. Okay, and then add the net income 360,000 minus the 300,000, so the balance or the ending retained earning will be 1,060,000. Alright, now we see reserve, or we also call it accumulated OCI. Reserve or accumulated OCI include the total change in equity that exclude transactions with owners, or in other words, it include the total change in equity uh, of the transaction with non-owners. So the typical transactions with non-owners, like such as here, what has been listed down here. Okay, um, so we start with the corporate income. So the corporate income is started with the net income. Net income add or minus certain unrealized gain and losses that are not reported on the income statement. So corporate income includes the following types of gain and losses that traditionally have been excluded from the net income, which is such as gain from revaluation of PPE, which is if your PPE is measured using the revaluation model, so you will have a gain from revaluation or revaluation surplus. And then if you have a net unrealized gain or losses on available for sale investment, um, and then if you have any deferred gains or losses on derivative, gain or losses from foreign currency translation, gain or losses from the amendments to the post-retirement benefit plans. Next will be the statement of changes in equity. Statement of changes in equity present the changes in permanent shareholders account. So generally it will comprise of shareholders share capital, ordinary share capital, um, also share premium, ordinary share premium. Preference shareholder you also can report here in the statement of changes in equity, and then you have the retained earnings and also accumulated balances in OCI. Okay, so the retained earning the changes in equity statement, you have to show all of this. The retained earning statement only shows the retained earning parts only. Okay, retained earning statement only shows the retained earning parts, but the changes in equity statement will show all the components of the equity. Okay, and then you show all the changes. So the statement of changes in equity will report the change in each equity account and in total equity for the period. That will include the accumulated comprehensive income for the period, contribution or issuance of shares, and distribution of dividends to their owners, and also reconcile the carry amount of each component of equity from the beginning to the end of the period. So this is how the changes in equity statement looks like. The statement of changes in equity presents the changes in permanent shareholders account. Okay, so here it discloses the source of changes in the permanent shareholders equity accounts. So regardless the display format used, here let's say the company Gil Spa reports the accumulated other comprehensive income 90,000 in the equity section of the financial position as follows. Okay, so you will show the accumulated other comprehensive income or reserve under equity section in the statement of financial position. So let's us look at the highlight of the conceptual frameworks for this accounting for shareholders equity. The sub classification of equity would be share capital and also several types of reserve. Okay, um, so when you show of this sub classification of equity, when you present each of the components of the equity, it will show the ability of the company distribute um distribute their equity to the shareholders. Otherwise, or how they apply to of their equity. So this will help the users to make better economic decision because you will provide um more relevant information to them, right? So I know throughout this course you see that there are um many different terms or terminology used in the IF, IFRS, and also if you refer other books also which is based in US, they will use the term that is that commonly used in the US gap. So you can see here the some of the differences between the terms used by IFRS and US gap. So like Malaysia, we use IFRS terms. Okay, commonly we use IFRS term, but some book they refer to the US gap. I mean, or they use the terms that is used in the US gap. So you just look at these terms so that you can get familiar with. It's just different term, but actually they are the same things. Okay, like for example, like in US they use stockholders, but IFRS we use shareholders, and then IFRS we use ordinary share, but for US GAAP they use common stock. Okay, and whereas yeah, share premium ordinary. So here IFRS we use share premium ordinary, but for US GAAP they will use premium on common stock or paid in capital in excess of par. Okay. Um, but yeah, paid in capital in excess of par or for common that is means the share premium. Okay, and then reserve for IFRS we use reserve, but for US GAAP they use accumulated OCI. Okay. Hmm, what else? Yeah. So that's all for this lecture. Thank you.